Hello and welcome to another Other Wave analysis. Right, so today I want to talk about the Treasury bond, the 20-year Treasury bond yield. Right, so previously, if you go and look at the history, not too long ago, I mentioned on the 3rd of May that I expect the 20-year yield to go down. Right, so just to play this clip, you can see that I have set this price target here. Right, and so today I want to update this count. Right, so obviously it has already reached the target, which is this line over here, slightly extended a bit before bouncing up. Right, so what's the update? Is the update for the wave. So last time we were here, right, and I updated like 1 2. Right, over here, what has happened is that this has formed into a 1 2 3 4 5 4 3, then a 4, and eventually a 5. So this is where we have already hit the target. So where do we go from here? Right. Over here, this entire structure itself, right, is a corrective wave up. So from here, this bounce up, I would actually say that it has already reached the target for the corrective action. So right now, what is going to happen is that this at this point is actually a good place to short the yield, which means that is if you are trading the futures, the bond futures, it's time to long the futures, right, to go up. So over here, where is the, let me remove this. Where shall we put in the price target over here? So for this, I would say that if I draw this, if it's a 1 to 1, it would be around this place, right? So this view should drop quite a bit, right? But to be more conservative, right, we shall set the first target to be where we see obvious support. So one is over here, right? And the other one will be here. Right? Take note that these targets themselves, they fall short of a third wave, right? So let me remove this outdated one. Okay, another way we can look at this is that even though this has already hit the target for corrective up, right, there's a chance that it will actually drag longer, and this will be like A, B, and C. This is a bit more advanced, but we can see over here that there are some other resistance over here corresponding to here. So if we pull this up, right, to where this place is, right? So let's say we expect A, B, C, right? Then this will hit nicely at this spot, okay, at this spot for a 1 to 1, right? So this is potentially a wave count where we will have something like this A, B, and C, right? So this is kind of like a turn count. So maybe a corrective wave be down and up for the wave before going down again. Okay. So this is kind of like theoretically the the best waveform, right? So a clear ABC over here, because over here you can see this correction over here. Let me zoom in. It's a bit small, right? And it's kind of flattish, right? So we can still consider this as a first wave, B down, C, right? Before going down again. So how would I update this? Is that I would then draw this arrow down here, right? So over here we can just wait. So the other entry point, just to put in how the entry point should be, right? Let me put a marker. So uh, I would suggest a scaling in approach. So this you do a small size, right? Then if it breaks down here, if you break down this level, right? You do another one, right? And then if you really move in an ABC manner, right, you can actually do this. So now you have a small position. If it breaks down, that means this is just a single, kind of like a single with correction. Then you will have you will do the second lot here. But if it goes down and up again, you have the place where you put in your full size at this, right? And this is actually kind of like if it goes down, you are in the money, and you can do additional lot to increase your risk over here once it breaks down, and so you can ride the entire wave down. So this is how I would trade the 20-year bond yield. So good luck to your trading. Thank you.